All right, this video is for the business owner, specifically the small business owner. So if you've got a great team, then you probably already know the struggle. It's keeping your best people around. A lot of times you try to give them salary bumps or throw the pizza party, right? But it only goes so far. So today, I'm actually breaking down 5 really powerful ways to retain your top employees using insurance, business insurance. And of course, we're gonna talk about tax benefits too. So let's get right into it. Every strategy that I'll give you today, not only will I tell you about who the strategy works best for, what type of business, but I'll also put some helpful links in the description like paperwork if you need to get that set up. And of course, I'll leave my contact information at the bottom or in the description of this video if you need to reach out in order to get this set up. So let's kick it off with one of the simplest but most effective options out there, and that is the executive bonus plan, also known as Section 162. So who in the world is this plan for? This strategy is going to be really great if you're an S Corp, if you're an LLC, or if you're a sole proprietor, and you want to retain just really 1 or 2 main people, key employees. So this means if you've got someone that's really like mission critical. So this is a sales lead, an office manager, a head technician. I'm just making them up here. This plan gives you really good long-term value. But of course, if your business is built around a super large team of equal level employees, seasonal roles, then this won't really help you. This is not the strategy for you. So let me tell you how this strategy works. You, the business owner, give a bonus to your key employee, but instead of just writing them a check, making extra money on their direct deposit, you use the bonus to pay for permanent life insurance in their name, the employee's name. They own it, they control it, and it builds cash value over time. So now let's talk about taxes. Who pays them? The business gets to pay the premium. That's the bonus, right? The tax on the business is treated as compensation, so it's fully deductible. The tax on the employee, the bonus is taxable income, but you can do a double bonus to give them enough to cover the taxes too. It's just up to you. Now again, let me stop and rehash here. The bonus was always going to be taxable income, but now you get to fully deduct that bonus because you bought the insurance. When you take policy proceeds, whether you take loans or it pays out, the policy does grow tax deferred and it can be accessed tax-free if we structure it properly, which I can help with. So here's kind of my real life example. Let's pretend you run a marketing agency and your creative lead is getting poached. Somebody's coming after him, they want him. So you offer this person an executive bonus plan. It's $7,500 extra bucks a year to fund a policy that she owns. So now she's got the long-term financial value and a reason to stay. If you need help on exactly how to structure that executive bonus plan, I'll put some helpful links in the description of the video. Strategy number 2, split dollar life insurance. So here's how split dollar life insurance works. If you like the idea of helping employees, but you actually just really want more control, then split dollar might be your go-to. So this is going to be perfect for S Corps, for C Corps, for LLCs who want to share the cost, but again, stay in the driver's seat. You want the control. Maybe you're grooming a partner. Maybe you're investing in someone that's got like a 5-year, 10-year horizon. Maybe you just want protection before full vesting, then this one's probably going to be for you. So let me explain how it works. 2 methods to do this one. You can do your endorsement method or your assignment. Endorsement method. The business owns this policy. It endorses a portion to the employee. Then you've got collateral assignment, second method. The employee owns the policy and the business gets paid back what it's invested. So again, what's important to this are taxes. First, who actually even pays for this plan? And this one, usually the business is going to pay the premiums, and the premiums are not deductible. For the employee, they do have taxes. They're taxed on the economic benefit only. So this is based on the IRS table. But when the proceeds happen, the business actually gets reimbursed. And the rest goes to the employee's beneficiary, and that's going to be tax-free. So again, let me give you a real life example here. You run an HVAC company. Your lead technician is a retention risk. They're good. So you offer a split dollar plan. He gets a policy that he owns eventually, and you protect your investment if he leaves too soon. Strategy number 3, and one of my personal favorites, is deferred compensation. So this is how you lock someone in for the long haul. This one is your ACE, your deferred compensation plan. It's super ideal for high earners, leadership people, and LLCs and S Corps and C Corps. If you want to provide retirement style benefits without a full-blown pension. So let me explain how it works. You agree to pay your employee a future benefit. Future. So either at retirement or after 5 years, 10 years, upon death, whatever you want, future. And it's funded by a life insurance policy that the business owns. The business gets to pay the premiums, and there's no deduction on those premiums paid for the business until the employee receives the payout. 5 years, 10 years, retirement. For the employee, the benefits of course are taxable income when they're received, but no taxes while it's growing. Of course, the policy proceeds are going to be tax-free to the business, and the benefits of course will be taxable to the employee when they're paid out. So here's my real life example. You own a veterinary clinic. Your lead doctor wants more than a salary. You're going to lose them if you can't provide that. So you set up deferred compensation funded by a insurance policy, and now your doctor gets retirement income later, and you don't lose your best talent to the big people who can offer the pensions and the big plans. Strategy number 4 is called group term carve out. So you probably already offer group life insurance. If you do not, maybe you should. You can, again, use the link in the description. We can talk about it if you like, but maybe your top performers need something better. So this is going to be great if you've got a business with maybe 10 to 100 people where you want to create a lot of extra incentives for your managers, for your directors, for your long timers. So instead of the same $50,000 death benefit for everyone, right? You carve out, that's why it's called that, your top people and give them individual permanent policies. Often you structure them as executive bonus plans or split dollar plans. That's why this one comes in this order. Now, of course, the business pays on this. And the business can deduct the premiums. It's just depending on the bonus, the executive bonus or the split dollar, depends on which one you pick. For the employee, the first $50,000 of the group term, of course, tax-free. But beyond that, you're taxable under the Table 1 rates. Again, that's an IRS thing. So here's my real life example. Maybe you run a multi-location restaurant. Your executive chef is the guy, he's everything. So you offer this carve out that gives him or her permanent insurance and cash value. That way they're not going anywhere, right? Strategy number 5, my second favorite. This one is really cool. A lot of people don't realize you can do it. And this is salary continuation or disability income. So this one shows you really care about your people. Salary continuation is amazing. This is really key and best for small businesses, 1 to 5 critical employees, where losing one would really shut you down, right? So think medical, think legal, think skilled trade, think financial services. So how does it work? You fund a policy that kicks in if your employee becomes disabled or passes away so that their family keeps receiving their income. It's often structured as an informal agreement, but you do need documentation. So again, click the link in the description of the video if you need to see what some sample documents to that looks like. The business, of course, pays the premiums and they are deductible just depending on how you structure it with that other documentation. The employee, when they get the money, their beneficiary, their spouse, whoever gets the money, that then it's taxable, it's income. So here's my real life example again. Let's pretend you are a dentist this time. Your office manager is disabled, but because of the policy, her family is going to keep getting the income while they recover and your business doesn't have to fall apart. These are just 5 insurance strategies, and they're not just tools to save taxes. They're tools to keep your best people close and show them that you care. So if you're ready to use one of these to protect your business and your team, then click the link in the description of the video, schedule a call, I'll walk you through it. Or just get down there and get all the documents that you need, take them to your legal professional so they can walk you through exactly how to set it up, the documents for you. I can help you find the right setup for your size, your budget, your goals, but again, we gotta click the link and reach out. Let's keep your A players exactly where they belong, right beside you and in your business.